Okay, so just imagine this for a second. You've just made a really big financial move, maybe shifting a good chunk of your retirement savings into something new, something that's supposed to give you income, maybe for decades, maybe, well, for life.
Right. A serious commitment.
Exactly. You sign the papers, you talk to the agent, seemed okay, and then the official contract lands on your doorstep. You sit down, maybe pour a coffee, start reading the actual fine print,
Wow.
and that little knot starts forming in your stomach, right? Did I really get all that? What about that fee? How does that return thing actually work if rates go up or down?
Hmm.
And, the kicker, what if interest rates suddenly jump tomorrow? Could I have gotten a way better deal just by waiting one more day?
Yeah, it's a classic feeling, isn't it?
Yeah.
Especially with these complex financial products. It's not like buying a stock where, the risk is pretty immediate and clear.
Right.
Or a CD where, okay, you break it early, there's a penalty, but it's usually spelled out simply.
Right.
Annuities. Looking at that full contract can feel like you've just been handed a map to a maze.
That's a good way to put it. The language can be thick, the mechanics tricky, and it's long-term. So any mistake feels, well, huge.
Yeah, potentially monumental.
And with most financial decisions, once you've clicked buy or signed the line, that's it. No do-overs.
Pretty much.
But with annuities, because they are so complex, because the impact stretches out for so long, regulators here in the U.S. actually built in a safety net, a specific mandatory window where you legally have the right to just hit pause, to say, hold on a sec, cancel the whole thing, walk away, and get every single penny of your initial premium back. No fees, no penalties, no hassle beyond just saying, I want out.
And that specific safety valve, that window, that's exactly what we're going to dive deep into today.
Yeah, we're talking about the annuity free look period.
Exactly.
And we've got some really good material to work with for this deep dive, looking at it from different angles. We've got articles explaining the basics, what it is, why it's there, from places like annuity.org and The Street.
Solid sources.
Then there's this super practical breakdown from Bankrate, which actually goes state by state on the minimum requirements. And that really shows you how much this can differ depending on where you live.
Ah, that's key. The state differences.
Totally. And maybe most importantly, we've got pieces of the actual regulatory language from the NAIC, that's the National Association of Insurance Commissioners. This is the stuff that tells the insurance companies what they have to tell you and how they have to explain it.
Okay, so we've got the concept, the practical variations, and the rule book itself.
Yep. So our mission today is to unpack all of this. We'll break down what the free look period actually is, why the states insist on it, how long it typically lasts, and why it's not always the same.
Right.
We'll get into why this window is probably the most critical time you have with that contract, what happens if you miss it. Spoiler, it can be expensive.
Very.
And then the really practical part for you, the listener. What exactly should you be doing during this period? What should you look for? Who should you maybe talk to?
Okay, sounds like a plan. Let's jump in and unpack this crucial safety net.
Let's do it. So first things first, let's just nail down the definition. What is the free look period in the world of annuities?
Right. So at its heart, it's a specific time frame. It's legally required, and it's there purely for your protection as the consumer.
Okay, a protection period.
Exactly. And a really crucial detail right away is when it starts, because it's not when you fill out the application.
No.
No, and it's not even the day the insurance company officially issues the policy. The sources are clear on this. The clock typically starts ticking on your free look period the day you actually receive the physical annuity contract.
Ah, so when it arrives in your mailbox or maybe electronic?
Precisely. When it's delivered to you, that's day one.
That's such a critical point. Gotta know when that countdown begins.
Yeah.
Okay, so during this period, what's the main power you have?
This is that undo button we mentioned. The core function is to give you, the buyer, the chance to cancel the contract after you've had time to actually see and review the real terms and conditions.
And if you do decide to cancel within that window, what's the big benefit compared to trying to bail out later on?
This is the absolute key takeaway. If you cancel during the free look period, the law says you get a full refund of your premium. Every dollar you initially put in comes back to you.
Every single dollar.
Every dollar of the premium you paid. And, crucially, as the sources stress, this happens without you facing any kind of fees or surrender charges.
Okay, so no penalties just for changing your mind after reading the contract.
None whatsoever during that specific period. That's the whole point of the protection. It lets you review it risk-free in that sense.
That really does stand out compared to other financial things, doesn't it? Like we said, you buy stock, market drops. Too bad.
Right? You sell at a loss. You can't just send it back.
And a CD, if you need the money early, you usually forfeit some interest, right? There's a known penalty.
Yeah, exactly. Those products, their risks or terms are often seen as maybe more straightforward, or the penalties are tied to a simple time commitment you broke. Annuities are viewed differently by regulators.
Why? What makes them so different that they need this special review time?
Well, they're insurance contracts, first off, usually aimed at long-term stuff like retirement income.
Yeah.
But the way they work can be, well, pretty opaque for the average person.
Opaque.
Yeah, like even a basic fixed annuity, you need to understand how the interest works, how it might change after the first few years, what the minimum guarantees really are. And immediate annuities, they often need a huge chunk of money up front, like $100,000 or more is often mentioned, just to get a decent income stream. That's a massive decision right there.
Okay, so even the simple ones aren't that simple. And then you have things like variable or fixed index annuities.
Oh, yeah, those add whole other layers of complexity. The sources talk about variable annuities having complex contract language, being packed with fees, qualifying terms. You're dealing with subaccounts, insurance riders, M&E fees, admin fees. It's a lot. And fixed index annuities. Your interest is linked to a market index, like the S&P 500, but you don't get the full index return. Your actual credit is calculated using things like participation rates, caps, spreads.
Caps, spreads, participation rates.
Yeah.
Those terms alone sound confusing.
They can be, and the formulas can be complex, and importantly, those caps and rates can often change every year after the initial term. So understanding how your money might grow is really complicated.
So it's not just market risk you're dealing with, it's understanding the product's own internal rule book, which could be, what, dozens, maybe hundreds of pages long?
Easily, and that's precisely why states and regulators like the NAIC step in.
Yeah.
They recognize that you need dedicated time away from the sales pitch with the actual rule book in your hands to really process what you've bought.
Makes sense.
The free look period is required because these things can be so complex. It's seen as a necessary safeguard. Protects you from getting locked into something long-term that maybe isn't right, just because you couldn't grasp all the details at the point of sale.
And just to hammer it home again, that crucial clock starts ticking when you receive the contract.
Absolutely vital. Got to watch that delivery date.
Okay, so we know what it is, why it exists. Now, the duration. How long is this period? Is it always, say, 10 days or?
This is where it gets really interesting and kind of highlights why you have to check the specifics for yourself. It varies a lot, actually.
Oh, really?
Yeah. While you often hear that 10 to 30-day range thrown around, the minimum time the insurance company has to give you is set by the laws in your specific state.
So my state's insurance department decides the shortest possible free look I get.
Exactly. And when you look at that state-by-state list, the range is pretty wide. A whole bunch of states do set the minimum at just 10 days. You see that in Alaska, Arkansas, Connecticut, Georgia, Illinois, Indiana, Iowa, Kansas, Louisiana, Maryland, Michigan, Missouri, Nebraska, Nevada, and North Carolina for new policies, North Dakota, South Carolina, South Dakota, Tennessee, Utah for new policies, and Washington State.
Wow, that's quite a list with only 10 days. That doesn't feel like much time at all for such a complex thing.
It really isn't very long, is it?
Yeah.
Which underlines why you need to jump on reviewing it right away if you're in one of those states.
Okay. Are there states that give you a bit longer?
Yes. Some require a minimum of 15 days. That includes places like Alabama, Colorado, Hawaii, Kentucky, Maine, Montana, New Mexico, Ohio, Oklahoma, West Virginia, and Wyoming.
15 days?
Yeah.
Slightly better. Anything special about those states?
Actually, yes. There's an important footnote in the sources for those specific 15-day states I just listed. The 15-day minimum might only apply if the insurance company didn't give you the official annuity buyer's guide and the required disclosure document at or before you applied.
Ah, so if they gave you the info up front, the 15-day rule might not kick in.
Exactly. In those states, if you got the docs early, the required free look might be shorter or maybe even zero, depending on their specific rules. It just shows how nuanced state regulations can be.
Wow, okay. So getting those documents early matters there. What about longer periods, more than 15 days?
Yep. Some states push it to 20 days minimum. That's Idaho, Massachusetts, Rhode Island. Delaware and Pennsylvania require 20 days, but specifically for replacement annuities, where you're swapping out an old policy for a new one. Their minimum for brand new ones is 10 days. Texas also requires 20 days for new policies.
Okay. And Florida, I think I saw that was slightly different.
Good catch. Yeah, Florida has a unique 21-day minimum.
Getting closer to 3 weeks there. Any states go even longer, like up to that 30-day mark.
Definitely. California requires a full 30-day minimum. Arizona mandates 30 days, but only if you're 65 or older when you buy. Otherwise, it's 10 days for younger buyers.
Interesting age distinction there.
It is.
Yeah.
And several other states require that 30-day period specifically for replacement policies, recognizing that those transactions can be even more complex or carry higher risks of being unsuitable. That includes Minnesota and Nevada for replacements, North Carolina for replacements, Oregon, Texas for replacements, Utah for replacements, and Wisconsin. South Carolina even has 30 days if it was sold via mail order.
So things like your age, or if it's a replacement, can really extend that review time in certain places. Seems like regulators are giving extra pause for thought in those situations.
Makes sense, doesn't it? And one more wrinkle. According to the sources, a couple of states actually have no legal requirement at all for a free look on new annuities.
Really? Which ones?
Mississippi and Vermont. Virginia is also listed as having no minimum for new contracts, though they do require 10 days for replacements.
Huh. That's surprising given how complex we've established these are. So if you live in Mississippi or Vermont, you're just hoping the insurance company gives you one voluntarily.
Pretty much.
Huh.
Although, in practice, many insurance companies operate nationally and might just offer a standard free look period, say 10 or 20 days, even in states where it's not legally mandated, just to be consistent or competitive. Some might even offer longer than the state minimum as a selling point.
Okay, so the absolute bottom line here seems crystal clear. You absolutely must find out the exact free look period that applies to you. That means checking your state's insurance department rules and reading the specific free look provision written right there in your annuity contract. The contract might give you more time than the state minimum, but it can't give you less.
Nailed it. Don't guess, don't assume. Know your specific number of days the minute that contract shows up.
Which brings us right to the next point. Why is this period so incredibly important? What's really riding on these 10 or 20 or 30 days?
Well, think of it like this. This free look period is essentially your last exit ramp on the highway. It's the final and really the only chance you get to fully size up the annuity contract after you've bought it, but before all those terms lock in and become legally binding.
And if you miss that exit, if you drive past the free look period and then decide you want out, what happens then?
That's exactly why it's so critical. The sources are very clear. If you try to cancel the contract or even just pull out a large chunk of your money after the free look ends, you're almost certainly going to get hit with hefty surrender charges and penalties.
Hefty? How hefty are we talking? That illustration example gave some numbers, didn't it?
It did. That example was for a $100,000 fixed annuity. It showed a surrender charge starting at 8% in the very first year.
8%. So on $100,000, that's $8,000 gone, just like that.
Potentially, yes.
Yep.
If you surrendered the whole thing in year one. Now, those charges usually decline over time. The example showed them going down to 0 over 8 years, but they can stick around for a long time, maybe 5, 7, 10 years, sometimes even longer, depending on the contract.
So buyer's remorse a year later could cost you thousands, plus maybe taxes on top of that.
Exactly. It makes accessing your own principal incredibly difficult and costly. Even later on, once maybe the annuity starts paying you income, getting at the underlying lump sum is usually tough.
Right.
Now, many contracts do allow small penalty-free withdrawals each year. That illustration mentioned a common one, like being able to take out 10% of your account value annually without triggering surrender charges.
Okay, so some limited access might be possible.
Right. But if you try to take out more than that allowed percentage or the whole amount, boom, you're likely facing those surrender charges again, plus potentially other penalties.
And aren't there tax implications, too, on top of the surrender fees?
Oh, yeah. Any gain in the contract would likely be taxed as ordinary income when you withdraw it. And if you're under age 59 and a half, you could also get hit with a 10% federal tax penalty, depending on the situation.
Ouch. One source said you could get slammed with charges. Sounds about right.
Yeah, it's not pretty. Which really underscores why that free look period is golden. It's the only time you can truly reverse the decision and get your full premium back without taking a major financial hit. Once that window closes, changing your mind gets very, very expensive.
And this brings us back full circle to the why, right? The complexity.
Exactly. Because these aren't simple savings accounts, and because the cost of getting out later is so high, that review period is deemed essential. You need that time to really dig into the contract, Understand the fee structure, figure out how those potentially complex return calculations work, especially with variable or index types, and confirm what's truly guaranteed versus what's just a projection based on today's numbers.
So it's not just about maybe finding a slightly better rate somewhere else during those few weeks. It's about making sure the fundamental deal, the structure, the terms are actually what you thought you were getting and what you need.
Absolutely. That free look is your safety valve. Even if you end up keeping the annuity, just knowing you had that chance to do a final thorough check provides real peace of mind. It's like a seatbelt, you know. Hopefully you don't need it, but it's vital to have it just in case.
Okay, the stakes are definitely high, and the time is short. So how do you make the absolute most of this critical free look period? What should you be doing, like, the minute that envelope or email arrives?
Job number 1, start reviewing immediately. Don't let it sit on the counter. Don't put it in the to-do pile for next weekend. That clock started the moment it was delivered.
Got it. Rip it open right away. Now, what documents should you be looking for inside, and what's the key information to focus on based on what the sources say?
Okay, you should definitely have the policy document itself. It's the full legal contract. You need to read through that, even though it might be dense. But alongside it, you should also get something called a disclosure document.
A disclosure document.
Yeah, and those NAIC rules we mentioned are very specific about what has to be in this document. It's basically designed to summarize the really important stuff in, hopefully, clearer language than the main contract.
Okay, so what kind of must-have info is in that disclosure according to the NAIC rules?
Well, it needs to clearly state the generic product type, the specific company product name, the policy form number, and say flat out that it's an annuity. It must have the insurance company's full legal name, address, website, phone number. And it needs a description that emphasizes the long-term nature of the product.
Making it clear this isn't your emergency fund.
Right. And critically, it has to detail both the guaranteed elements and the non-guaranteed elements, any limitations too. For things like fixed indexed annuities, it has to explain those key terms, participation rates, caps, spreads, and actually describe how they work to calculate your interest.
And didn't you say the NAIC requires that explanation to be in plain English?
Yes, that's a huge requirement. Terms must be defined in plain language so a typical person can understand. They can't just throw jargon at you. They have to explain what a cap or a spread actually means for your money.
That's good. What else is covered in the disclosure?
It needs to spell out the initial interest rate, or for index types, how the initial index credit is figured out. It has to mention any bonus rates, how long they last, and this is vital state clearly that future rates can change and are not guaranteed.
That seems like one of the biggest potential misunderstandings.
It really is. You absolutely have to check that during the review. The disclosure should also cover your options for taking income later, again separating guaranteed payouts from non-guaranteed projections. It must explain how withdrawals or surrendering the contract could reduce your value, those fees we talked about.
Okay.
It should explain how you can access money, like those penalty-free withdrawal rules, and what happens if you take out too much. It needs to explain any death benefit, if there is one. Summarize the tax situation and potential penalties. Detail the impact of any extra riders you bought, like for income or long-term care. And list out all the specific fees and charges, either as dollar amounts or percentages.
Wow, that disclosure document sounds like the real centerpiece for review. It pulls all the key, potentially tricky bits into one spot.
That's exactly the idea. It's supposed to be your go-to summary. You should also get an annuity buyer's guide that's more general, explaining different types of annuities, helping you kind of place yours in context.
Right. And what about illustrations? Lots of people see those charts showing how money might grow.
Yeah, illustrations are very common. But the absolute crucial thing to remember, and the sources stress this, is that they are projections. They are not guarantees.
Not guarantees, okay.
And the NAIC has rules for these too. If you got an illustration, it has to be clearly labeled illustration. It should point you back to the disclosure doc and the buyer's guide, and it must show the guaranteed elements and the non-guaranteed elements separately and clearly identified.
So you should see, like, here's what happens if we only pay the minimum guarantee alongside the projection based on current rates.
Exactly. And it must have statements saying benefits aren't guaranteed, assumptions can change, actual results might be different. It should be based on specifics. Your premium, $100K example, your age, 54 example, the guaranteed rates, the minimum guaranteed rate, 3% example, the surrender charge schedule, 8% down to 0% example.
Right.
It should also show the difference between your account value and your cash surrender value, what you'd actually get back after fees if you bailed early.
That difference seems important to see clearly.
Very. And for those fixed-indexed annuities, the illustration rules are even more involved.
Oh, how so?
The NAIC model says those illustrations have to show at least 3 different scenarios based on the index's past performance. The most recent 10 years, the 10 years with the lowest returns in the last 20, and the 10 years with the highest returns in the last 20.
Trying to show a range of historical possibilities.
Yeah, but again, it's history, not a crystal ball. They also have to clearly state the assumptions they use for things like caps and participation rates to generate those past scenarios.
Man, that sounds like a lot to unpack, especially if you're not, a math whiz.
It really does highlight why you need that dedicated review time, doesn't it? Illustrations also have to explain any market value adjustment, or MVA, if your contract has one.
MVA. What's that?
It's an adjustment that can increase or decrease your surrender value based on how interest rates have changed since you bought the annuity. The illustration needs to explain it simply and show how it might work. Like, if rates went down, it might boost your payout slightly, but if rates went up, it could reduce your payout, though not below the guaranteed minimum. They often use graphs for this.
Huh. So the MVA could be another potential hit if rates rise and you try to leave early.
It's a factor to be aware of, yes. Illustrations also need a numeric summary showing key values at specific times, like the first 10 years, every 10 years up to maybe age 70, and at the point you might have to start taking income.
Okay, so the big task during the free look is systematically plow through all this paper contract, disclosure, guide, illustration. Compare it to what you were told, look for anything confusing or unclear, identify red flags.
That's the core of it.
Yeah.
And let's be honest, trying to do that all by yourself with such complex documents, it can be overwhelming. Which leads to the next really crucial step during your free look period.
Which is?
Seeking independent third-party expert guidance.
Getting a second opinion. Who should you think about talking to during this limited time?
Well, you could talk to a lawyer, maybe one specializing in contracts or elder law, to help decipher the legal language. A tax professional, a CPA, or enrolled agent can clarify the tax treatment now and down the road. And of course, a financial advisor can help assess if this specific annuity truly fits your overall financial picture, your goals, your risk tolerance.
Why is getting an unbiased opinion so stressed here in the sources?
Yeah, this point comes up repeatedly. Annuities, especially certain types, often pay pretty high commissions to the agent or broker who sells them. Now, commissions aren't automatically bad, but that structure can create a potential conflict of interest. An incentive, perhaps, for a salesperson to recommend a product that pays them well, even if it's not the absolute perfect fit for your specific situation.
Okay.
That's why you see strong recommendations in the sources to talk to a fee-only financial advisor or a fee-only insurance advisor during this free look.
Fee-only, meaning they're paid directly by me for their time and advice, not by the insurance company whose product they might recommend.
Exactly. Their payment isn't tied to selling you anything. So their advice is focused purely on what's suitable and best for you. There's a great quote from an actuary, Scott Witt, in one article, basically saying it boils down to suitability. Is this product a good fit for what you need, or is it just something being sold?
That suitability check seems absolutely vital, and getting that unbiased look during the free look seems like the perfect time. The sources also suggest asking yourself some basic suitability questions again during this review, right?
They do. Things like, okay, looking at the real numbers and guarantees, will this annuity actually fill the income gap I expect in retirement? Am I truly okay potentially missing out on higher market gains in exchange for this specific level of guaranteed income? Do I need income just for me, or for a spouse too? For life, or just a set number of years?
The kind of big picture questions the contract details should answer. What else is on the free look checklist?
Definitely check the financial health of the insurance company that issued the annuity. This is super important because annuities aren't like bank accounts. They aren't FDIC insured.
Right. No federal guarantee.
No. Now, there are state guarantee associations that offer some protection if an insurer fails, but there are limits, and it's not the same thing. Your main security is the company's own ability to pay claims decades from now. So look up their financial strength ratings from agencies like AM Best, S&P, Moody's, Fitch. Maybe check customer satisfaction scores too, like from J.D. Power.
Makes total sense. You're signing up for a long-term promise. You need confidence they'll be around to keep it.
And the last piece of advice throughout this whole process, if anything seems confusing, unclear, contradictory to what you were told, or just doesn't feel right, ask questions. Contact the insurance company's customer service. Contact the agent who sold it to you. Get clarification on every single doubt before that free look window closes.
Okay, so let's recap that action plan for the free look. Open it immediately. Read everything: contract, disclosure, guide, illustrations focusing on guarantees, fees, calculations. Get independent fee-only advice. Re-ask yourself the suitability questions. Check the insurer's financial strength. And ask about anything you don't understand. That's a busy few days or weeks.
It definitely requires focus and effort, but it's really the only way to use that safety net effectively and make sure you're comfortable with the commitment.
All right, so you've done all that hard work. You've read, maybe you talked to an advisor, you asked your questions. Now comes the decision. Keep it or use the free look to cancel. The sources gave some scenarios on when canceling might or might not make sense, right?
Yeah, those examples from Ken Noose were pretty helpful, I thought. Let's look at the one where canceling is probably not worth it. Say you bought a $100,000 fixed annuity at a 3.00% rate, guaranteed for a few years. 20 days into your free look, you notice similar annuities are now offering maybe 3.10%.
Okay, a tiny bump up, 0.10% difference.
Seems tempting? Maybe. But let's break down the cost of switching using the source's logic. First, if you cancel, you give up any interest your original policy might have earned during those 20 days you held it. At 3.00% on 100K for 20 days, the source calculated that's about $370 in lost interest.
Okay, so you forfeit that $370 right off the bat.
Right. Then the process of canceling, getting your $100,000 premium back from the first company, that takes time, maybe 1 or 2 weeks, the source estimates. Then you have to apply for the new annuity at 3.10%, wait for it to be issued. The whole time your money's out of the market, essentially, could be around 45 days total.
45 days earning nothing while you switch.
Well, you're losing the opportunity to earn during that time. And the source specifically highlights the interest lost during the free look itself on the original policy, that $370. Now you're trying to make up that $370 loss just by earning an extra 0.10% per year on your $100,000 with the new policy.
How long does that take?
The source ran the numbers. It would take about 3.5 years of earning that extra 0.10% just to break even and recover the $370 you lost by canceling the first policy.
Wow. 3.5 years just to get back to square one, all for a 0.10% rate difference? That really changes the perspective.
It does, doesn't it? Factor in the hassle, the paperwork, waiting for your money. The conclusion seems pretty clear. For tiny rate changes, using the free look just to chase that small difference usually isn't worth the cost and effort.
Okay, so when might it be worth using the free look to cancel?
The source points to a scenario involving a really dramatic market shift. Something unexpected, maybe like the kind of rate spike seen during major economic events. They mentioned September 2008 as an example period where rates could move significantly. So imagine you got that 3.00% annuity, but during your free look, rates suddenly jump, and now a comparable product is offering, say, 3.50%.
Okay, that's a much bigger difference, 0.5%.
Exactly. Now, you still have that initial cost. You still forfeit the interest earned during the free look on the first policy, that $370 again. You still have the downtime while switching, but that much higher rate of 3.50% versus 3.00% lets you make up that lost ground way faster.
How much faster?
The source calculated that earning the extra 0.50% on $100,000 would recoup the $370 loss in about 9 months.
9 months compared to 3.5 years. Okay, that sounds like it could definitely be worth the switch.
Big difference, right? So the takeaway is canceling during the free look makes the most sense if either. 1, you discover a fundamental problem with the contract itself. The fees are way higher than you thought. The guarantees aren't what was represented. It's just not suitable for you once you see the details. Or 2, there's been a truly significant major shift in the market, making a new product dramatically better.
It's not really meant for fine-tuning based on tiny rate fluctuations.
Exactly. And just to reiterate that final point about canceling, you get your premium back. You do not typically get any interest that might have technically accrued on the policy during the free look days. That's usually forfeited when you exercise the free look cancellation.
Right. It's about getting your principal back safely, not earning interest during the review.
Precisely. The goal is to unwind the transaction without penalty to your initial investment.
This has been a really informative dive into, honestly, a crucial piece of consumer protection. Let's try and wrap up the absolute must-know takeaways for everyone listening.
Okay, I think the number one thing is just understanding that the annuity free look period is your legally guaranteed safety net. It's a limited time, could be 10 days, could be 30. Check your state and contract starting when you get the contract. And during that window, you have the absolute right to cancel, get a full premium refund, no surrender charges, no fees. period.
And it exists specifically because annuities can be so complex. Regulators know you need time with the actual documents, away from the sales pitch, to really understand what you've committed to before you're locked in, potentially for decades.
Right. Which means the most important thing you can do is actively use this period. Don't let it slide by. Open the contract right away. Read the policy. Read that disclosure document. Really focus on what's guaranteed versus not, the fees, how returns work. Check the buyer's guide. Scrutinize any illustrations. Remember, projections aren't promises.
And don't try to figure it all out alone if you're unsure. This is the perfect time, maybe the only easy time, to get that unbiased advice from a fee-only advisor, maybe a lawyer, a tax pro. Make sure it truly fits your needs before that clock runs out.
Yeah. And deciding whether to actually use the free look to cancel usually comes down to finding a real mismatch in suitability once you see the contract details, or if there's been one of those rare major market shifts that makes a new option significantly better. Minor rate tweaks. Probably not worth the hassle.
You're right. It's there to protect you and your money. Use that window effectively.
You know, thinking about how complex these products are and how vital this mandated review period is, it does make you wonder, doesn't it? What other big financial commitments do we make long-term things, complex contracts that don't have a built-in safety net like a free look?
That's a really interesting question.
And maybe more practically, even when there isn't a law forcing us to pause, how can we create our own kind of free look process? You know, deliberately taking the time, seeking that independent advice, making sure we truly understand the commitment before we sign on the dotted line, especially for things that lock us in for years.
That's a powerful thought. Building in our own pause and review, even when it's not required. Applying that principle of informed consent with a chance to reconsider seems like a variable habit well beyond just annuities.
Indeed it does.
Well, thank you for walking us through all of that. Hopefully this deep dive into the annuity-free look period leaves you feeling better equipped to handle that critical window if and when you encounter it.
Absolutely. Thanks for tuning in, everyone. We'll be back with another deep dive soon.